Welcome to the Deep Dive, where we cut through the noise to bring you the most crucial insights shaping our world. Now, when we talk about global finance, our minds often jump to the titans, the enduring US dollar, perhaps the rising digital yuan. But what if an unexpected player, seemingly quieter, is strategically positioning itself to become a truly dominant force in the fast-paced world of digital payments? What if Japan is about to redefine how money moves across the globe? Today, we're embarking on a deep dive into JPYC, Japan's yen-pegged stablecoin, and its incredible potential to not just join the ranks, but fundamentally reshape the landscape of cross-border transactions. This isn't just about a new digital currency. It's about a new paradigm that could impact everything from, your online shopping to major international trade deals.
Absolutely. And our mission for you today is to really pull back the curtain on this unfolding story. We're going to untangle the intricate regulatory battles currently playing out globally. We'll dissect the nuanced geopolitical chess game that uniquely positions Japan for success and explore the technical innovations that could elevate JPYC to a one ring to rule them all kind of status for international transactions. Our goal is to arm you with the crucial understanding of what this means for your future international payments, your investments, and the very fabric of the global financial order. Let's dive in and prepare for some surprising insights.
Okay, let's unpack this. When we talk about stablecoins and the urgent need for clear rules, the United States, as a global financial powerhouse, is often seen as a critical player. We've heard a lot of buzz about the Genius Act, right? A significant piece of legislation meant to bring order to this space. On paper, it sounds incredibly promising, a real step forward. But what's the actual reality of its implementation? Is it a quick fix, or is there more to the story?
Well, the crucial point here, and it's often overlooked, is the vast chasm between a law being signed and that law being fully effective in practice. The Genius Act, signed into law on July 18, 2025, was indeed a monumental achievement. It lays out a comprehensive framework defining permitted payment stablecoin issuers, which is frankly precisely what the industry has been clamoring for, to foster innovation and security. However, and this is the vital detail, its provisions do not become enforceable immediately.
So it's not simply an instant flick of a switch, despite the big headline. That feels like a classic legislative delay we've seen before. What kind of timeline are we really looking at for this law to actually bite?
Exactly. The Act's effective date is the earlier of two possibilities. First, it's 18 months after its enactment, which would push us out to, January 18, 2027. Or second, it becomes effective 120 days after federal regulators, and we're talking about powerful agencies like the Office of the Comptroller of the Currency, the OCC, the Federal Reserve, and the FDIC, the Federal Deposit Insurance Corporation, issue their final rules for its implementation. That second point is where the real complexity and, frankly, the delays inevitably lie.
Okay, so it's a frantic race against the clock for these regulators. But stablecoin regulation involves massive, unprecedented issues, right? Covering everything from cybersecurity to consumer protection. My intuition tells me this is where the gears grind slowly, potentially dragging well beyond that initial deadline. Am I on the right track here?
Your intuition is absolutely spot on. It is highly plausible, almost inevitable, that the 18-month deadline will be reached, or even effectively exceeded, before we see a fully functional, clearly defined regulatory environment in the U.S. The federal rulemaking process is notoriously complex, a bureaucratic labyrinth, really. And it's not at all unusual for it to take a significant amount of time, especially for legislation as broad, technically demanding, and impactful as the Genius Act. Think of it like this. Approving the architectural blueprint for a magnificent skyscraper is one thing, but then imagine getting every single engineer, contractor, and city inspector to agree on the precise specifications for every single pipe, every beam, every safety protocol, and how it connects to the entire city's infrastructure. That's where the real complexity and time commitment come in. With stablecoins, we're talking about not just financial security, but also novel technical details that need to be practical, effective, and fair across a rapidly evolving digital landscape. It's just a painstaking process to get it right and to ensure it stands up to scrutiny.
That makes perfect sense. Beyond just the sheer volume of work, what specifically makes this process so slow and cumbersome for U.S. regulators? What are the practical steps that cause these inevitable delays?
Well, it's a strict multi-stage process governed by the Administrative Procedure Act, or APA. First, agencies have to publish a proposed rule in the Federal Register and open it up for public comment. This period is typically 30 to 60 days, but for something as intricate as stablecoin regulation, it can easily stretch to 90 days or even longer, inviting feedback from a vast array of stakeholders. Then comes the painstaking review process. Agencies must meticulously sift through and respond to all significant comments, which can mean analyzing thousands, potentially tens of thousands of pages of feedback from diverse groups. Industry heavyweights, consumer advocates, academics, even individual citizens. This is incredibly time-consuming, requiring careful legal and technical analysis. After that, they must draft the final rule. And that isn't just the rules themselves, but also a comprehensive preamble. This preamble explains the rule's legal basis, its purpose, how comments were addressed, and why certain decisions were made. This part alone is labor-intensive and often contentious.
Right. And I imagine these agencies aren't exactly flush with unlimited resources or staff dedicated solely to stablecoin rules. There are lots of other things demanding their attention too.
Precisely. Regulatory agencies frequently operate with limited staff and funding, forcing them to juggle multiple priorities. Moreover, the Genius Act likely impacts several federal agencies, not just one, so there's an additional challenging layer of interagency coordination required. They need to ensure consistency and avoid conflicting regulations, which means more meetings, more negotiations, and, well, more time. And even after all that, once a final rule is published, it can still be challenged in court by dissatisfied parties, leading to further delays or even forcing agencies back to the drawing board. It's a gauntlet, truly.
So for you, our listener, and for businesses trying to operate in this cutting-edge space, what does all this regulatory grinding actually mean? It sounds like you're stuck in a very long, very uncertain regulatory limbo.
Yes, and this is a pivotal insight for you. This regulatory limbo creates immense uncertainty. Without clear final rules, businesses are left guessing exactly how to comply. They often have to rely on preliminary guidance, or worse, their own interpretations, which leads to confusion and significant legal risk. It's incredibly difficult for regulators to effectively enforce a law without specific, detailed rules to back it up. So, while the 18-month deadline technically ensures the law will be enforceable, the practical reality of a truly clear and complete regulatory environment, one where businesses feel confident to invest and innovate, might extend well beyond that. You're effectively forced to operate in a legal gray area for a substantial period.
Okay, so that's the U.S. picture promising legislation, but slow execution. Now, this starkly contrasts with another major player, Japan, which has taken a surprisingly decisive lead. While the U.S. is navigating this complex rulemaking process, Japan seems to have moved with remarkable speed and clarity. It's a fascinating difference in approach.
It truly is a stark, illuminating contrast. Japan has demonstrated a clear competitive edge here, not just talking about stablecoin regulation, but doing it. Their stablecoin law was enacted way back in June 2022, and crucially, it fully came into effect on June 1st, 2023. This positioned Japan as one of the very first major countries globally to establish such a clear, active, and comprehensive legal framework for stablecoins. They got a significant head start, a really big one.
That's a monumental head start, really.
Yeah.
What are the key elements of Japan's framework that make it so robust and, more importantly, immediately actionable? What did they get right?
Well, the Japanese law immediately established a strong foundation of trust and consumer protection. It clearly defines stablecoins as electronic payment instruments, requiring them to be securely pegged to a fiat currency, like the Japanese yen, and guaranteeing redemption for that pegged currency. This isn't some vague promise, it's enshrined in law. Moreover, and this is key, only highly regulated entities, licensed banks, registered money transfer agents, or trust companies are permitted to issue stablecoins. This structure ensures transparent redeemability and robust protection for customer assets, directly addressing many of the concerns that have plagued less regulated corners of the crypto market. But they didn't stop there. This is a dynamic framework. A March 2025 amendment further enhanced flexibility, which is a sign of pragmatic and responsive regulation. This amendment allows trust-type stablecoin issuers to back up to 50% of their reserves with low-risk instruments, such as short-term Japanese government bonds or fixed deposits, rather than requiring full cash backing. This seemingly small technical detail is incredibly important for commercial viability, as it lowers operational costs for issuers and makes stablecoins a more attractive business proposition, ultimately benefiting users like you.
Okay, so if we look at the bigger picture, Japan's framework isn't just on the books. It's active, it's regulating, and it's providing certainty now. Meanwhile, the U.S. is still wrestling with foundational rule writing. This timing advantage alone seems absolutely monumental for attracting digital finance innovation.
Absolutely. That timing advantage is a major differentiator in the global race for digital finance dominance. For businesses and innovators, certainty is truly gold. Japan is offering a clear, live regulatory path today, which is a huge draw for investment and innovation in the digital asset space. It signals stability and a welcoming environment for properly regulated players.
And leading the charge on this is JPYC Inc. They are at the forefront, poised to launch Japan's first fully compliant, domestically issued yen-pegged stablecoin, also named JPYC. This isn't just abstract policy talk. This is a tangible product, tested and regulated, ready for the market.
Yes, and what's truly pivotal here is that JPYC appears to have received its final approval from the Financial Services Agency, or FSA, as of August 18th, 2025. This is a crucial, defining milestone. It means JPYC is officially transitioning from being a prepaid payment instrument, essentially like a digital gift card, to a funds transfer service under Japan's Payment Services Act. This grants it a much higher level of regulatory clarity and consumer protection, putting it firmly in the mainstream of financial instruments. The official release of this new, fully regulated JPYC is anticipated in fall 2025, following its inclusion in the FSA's registry. This isn't just another digital token launch. It's a significant, practical case study and the first real-world test of Japan's robust regulatory framework. It proves that a private company can successfully navigate these stringent requirements and bring a compliant, trustworthy product to market. It really offers a template for others to follow.
And I've heard they have a really interesting business model, something quite revolutionary when it comes to transaction fees. How do they plan to generate revenue if they're not charging users? That sounds counterintuitive.
That's where it gets really clever and potentially disruptive. JPYC aims to issue up to $1 trillion. That's roughly $6.78 billion worth of stablecoins over the next 3 years. A huge amount. But the game changer for users like you is this. They plan to not charge transaction fees. Zero. Instead, their revenue will come from the interest earned on the Japanese government bonds, or JGBs, that will securely back the stablecoin. Think about the impact for you, the listener. If you're a small business regularly making international payments, or even a consumer sending money abroad, zero transaction fees could mean substantial savings. This no-fee model could be incredibly disruptive for digital payments, driving widespread adoption by drastically reducing costs for everyday users and businesses alike. It's a strong incentive built right into their fundamental business strategy.
That's not just bold. It's a potential paradigm shift. And it's not staying isolated in some niche crypto corner, is it? I hear JPYC is already integrating with traditional finance.
Exactly. This isn't just a theoretical exercise. As of September 2025, JPYC is already integrating into the existing financial ecosystem. For example, the Nudge Card credit card is set to accept JPYC for repayment starting in October 2025. This shows a rapid move from regulatory approval to... Right. And this is where we hit a fundamental trade-off. The tension between radical efficiency and absolute safety. Japan's stablecoin law is intentionally designed to create a ring-fenced system. Imagine Japan building a high-security digital vault for its currency where every entry and exit is meticulously controlled and recorded. That's essentially their ring-fenced approach to stablecoin regulation. This means stablecoin issuance and exchange are strictly controlled by licensed, highly regulated entities. The why is deeply rooted in prioritizing financial stability, robust consumer protection, and critically, the stringent prevention of illicit activities like money laundering. It's a deliberate, strategic choice to harness the benefits of digital assets, think lightning speed and ultra-low costs, without sacrificing the control, oversight, and accountability that traditional financial systems maintain. This stands in stark contrast to the often unregulated, decentralized nature of much of the broader crypto ecosystem. Japan wants innovation, yes, but only within clear, secure, and ultimately trustworthy boundaries. It's about ensuring absolute trust and ironclad accountability at every single step.
That controlled approach, while logical for security, surely leads to some challenges when you think about connecting to other stablecoins, especially foreign ones. We've got this foreign stablecoin problem. How does Japan navigate that gap, and what does the trust spectrum look like for different stablecoins from a Japanese regulatory perspective?
You've identified a critical juncture. Japan's initial law aimed to restrict foreign-issued stablecoins like, say, USDC or USDT from direct, widespread distribution within Japan. This was primarily about limiting exposure to assets and entities outside the direct oversight of the Financial Services Agency, or FSA. So if we envision JPYC seeking to connect with other stablecoins, the regulatory comfort level would vary wildly depending on the counterparty. Let's illuminate this with two very distinct scenarios. On one end of the trust spectrum, you have Tether, USDT. It's issued by a private company outside Japan, not a regulated bank, and it has faced historical scrutiny regarding reserve transparency and auditability. It's a big player, but complex. Now, if JPYC were to establish an automatic exchange bridge directly linking to Tether, it would effectively bypass Japan's centralized controls. This would permit users to swap JPYC for USDT without the stringent anti-money laundering and know your customer, or AML-KYC, checks required by a regulated Japanese entity. This would directly undermine the very intent of Japan's law to prevent illicit finance and ensure user protection. Such a bridge would mean ceding control and oversight to an entity operating entirely outside the FSA's jurisdiction, creating a major red flag for regulators deeply concerned about illicit finance flows. JPYC's model relies on trust-based confidence, where your assurance comes from a licensed, audited Japanese company. Tether, however, operates more on an attestation-based model, where confidence largely stems from self-attestations and its sheer market presence. These are fundamentally different trust models and a huge point of contention for regulators. Now, let's consider the other end of that spectrum. JP Morgan's JPM coin. This is a private, permissioned digital token meticulously representing US dollars on deposit at JP Morgan Chase, which is, of course, a highly regulated US bank. It operates on a permissioned blockchain platform called Onyx, now integrated into its Kinexi system, very controlled. A direct peer-to-peer connection between JPYC's regulated system and JP Morgan's equally regulated system is not just plausible, it's highly probable. This could be achieved through permissioned blockchains, direct CBDC, that central bank digital currency bridges, or highly regulated API integrations. The Japanese FSA would be significantly more comfortable with JPYC engaging with JP Morgan due to its highly regulated status and unwavering compliance with U.S. and international financial regulations for AML, KYC, and sanctions. This isn't just about exchanging digital assets, it's about exchanging two trust-backed assets between two highly regulated financial institutions agreeing to a controlled and compliant exchange mechanism. Much more palatable.
So what's the big takeaway here for you, the listener? It truly sounds like a tale of two stablecoin philosophies colliding, or in some cases, collaborating based on trust.
Indeed. This is the aha moment about why trust and regulation are absolutely paramount for Japan. It's the decentralized, public, often higher risk model like Tether versus the institutional, permissioned, highly regulated model of JPM coin. Japan's strategy is explicitly designed to separate these based on regulatory trust and a deep understanding of who is ultimately accountable. They aren't against foreign digital assets per se, but they are absolutely insistent that any connection maintains their stringent levels of oversight, transparency, and consumer protection. No compromises there.
Okay, here's where it gets really interesting for you, because we're moving from the theoretical to the truly transformative.
Yeah.
If we connect all these pieces, the ultimate vision for JPYC isn't just about being a domestic stablecoin for Japan. It's to act as a central hub or anchor for a truly global network of digital currency payments, offering automated instant conversions. This is the ambitious one ring to rule them all vision we've been hinting at.
Exactly. And the profound implication here is how these plausible automated bridges could fundamentally transform international trade and payments as we know them. Imagine the kind of scenarios that become possible. A U.S. company could send JPM coin, representing U.S. dollars, to a Japanese counterparty. Through this JPYC hub, the JPM coin would automatically and near instantly convert to JPYC. This effectively bridges two highly regulated, bank-backed digital assets, creating a seamless, near-instant transaction that traditionally would take days, maybe longer. But the vision doesn't stop there. An even more transformative idea involves a U.S. company needing to pay a Chinese supplier. Instead of the traditional, often multi-day, multi-step process involving multiple currency conversions and intermediaries, JPM coin could automatically convert via JPYC into ECNY, China's digital yuan, at the recipient's end. JPYC acts as a secure, trusted intermediary, the central pivot point for these complex cross-currency flows, streamlining the entire process. It's the glue.
So for you, our listener, what are the direct, tangible benefits of such a system for your business, your investments, or even your personal international transactions? Break it down for us.
The advantages are truly profound and directly impact your bottom line and efficiency. First, efficiency. We're talking about near instantaneous, seamless transactions. This eliminates the multi-day foreign exchange processes and settlement delays we've come to expect with traditional banking systems like SWIFT, the Society for Worldwide Interbank Financial Telecommunication. Gone. Second, and crucially, cost reduction. The JPYC model, with its zero transaction fees plus the elimination of multiple intermediary banks and conversion costs, could significantly slash fees. Imagine you're a small business in Ohio paying a supplier in Vietnam. Those savings on every single transaction add up rapidly. It's real money back in your pocket. Third, reduced risk. Transactions occur between highly regulated institutions, reducing your exposure to volatile or less transparent digital assets. You're dealing with regulated trust. And finally, global connectivity. This creates a true network of networks, allowing countries to maintain their monetary sovereignty and control while participating in a hyper-efficient, secure global financial system. Think of a freelance designer in Italy receiving payment from a client in Korea. Instead of navigating disparate banking systems and fees, a JPYC hub could make it as simple as a domestic transfer. Really powerful. Let me give you an even more tangible example. Consider a multinational like Siemens. If Siemens, holding JPYC in its Japanese subsidiary, needed to pay a Chinese supplier, imagine the current complexity. Moving euros to US dollars, then converting to Chinese yuan, all via a slow, costly SWIFT transfer. Painful. With JPYC as the hub, they could send yen stablecoins directly. This automatically converts to ECNY for the Chinese recipient, making payments lightning fast and ultra efficient. It simplifies a complex process into a seamless digital flow. That's the real power of this hub concept.
That's a truly revolutionary vision. And a crucial piece of this grand vision isn't just about technology, but about Japan's own strategic positioning. Compared to the often competitive geopolitical stances of the U.S., which leverages its dollar, and China, which is pushing its ECNY, Japan's foreign policy is often characterized by a more neutral or bridging approach. How significant is this neutrality in making JPYC a potential global hub?
That raises an important point about the non-financial geopolitical levers in global finance. Japan's neutrality is, in fact, a massive geopolitical advantage. It's quite unique. Historically, Japan has pursued what's known as omnidirectional diplomacy, striving to maintain political neutrality while simultaneously expanding economic ties globally. It's a strong U.S. ally and a G7 nation, yes, but it's also deeply integrated economically and culturally with East and Southeast Asian economies. This unique position allows JPYC to be perceived as a uniquely trusted intermediary. Western companies, for instance, can place immense trust in JPYC due to its G7 regulatory oversight, seeing it as a safe, compliant, and predictable option. No surprises. Simultaneously, Asian and Chinese partners who might view a direct link to the U.S. financial system with some suspicion due to its potential for geopolitical leverage may find a Japanese stablecoin far more palatable, less baggage. Japan consistently prioritizes economic cooperation and stability, meaning JPYC can be perceived as a tool for global economic integration rather than a weapon in currency wars. This singular position allows JPYC to potentially serve as a trusted, non-aligned hub for a new global payments network, deftly avoiding the geopolitical baggage that often accompanies direct transactions in USD or ECNY. It truly is a diplomatic and economic masterstroke.
Okay, speaking of trusted intermediaries and geopolitical complexities, another key player is rapidly emerging: Hong Kong. Operating under the One Country, Two Systems framework, it's quickly established its own clear and robust regulatory framework for stablecoins with its Stablecoins Ordinance, effective August 1st, 2025. This seems to position Hong Kong as a vital superconnector, especially concerning China. How does that fit in?
Yes, Hong Kong. What's truly fascinating here is Hong Kong's unique strategic value in this global digital finance chess game. It acts as the primary, most trusted gateway to and from mainland China's financial system for international companies. Indispensable, really. This makes it an essential superconnector. Its separate legal system and strong regulatory traditions mean it's trusted by both Western nations, like Japan and mainland China. For Beijing, Hong Kong serves as a regulated sandbox. It allows China to experiment cautiously with cross-border digital finance, for example, through yuan-backed stablecoins issued out of Hong Kong without directly exposing the mainland's tightly controlled and sensitive financial system. It's a buffer zone. This effectively addresses what many refer to as the ECNY problem. Many countries, particularly democracies, are wary of directly accepting China's digital yuan due to concerns about surveillance and state control. A Hong Kong stablecoin could act as a private sector gateway to the ECNY system, making the ECNY more accessible to foreign entities while maintaining a crucial layer of separation and critically perceived trust for international users. Plus, Hong Kong's licensing regime is live and accepting applications now, potentially making it faster to see fully licensed stablecoins operating there than in the US. This regulatory agility gives it a significant edge.
Right, but this one-ring vision of seamless global payments sounds incredibly powerful, almost utopian. But we have to address the geopolitical elephant in the room that even the most advanced digital technology can't simply bypass. What about Russia? Can JPYC or any of these potential bridges connect to the digital ruble? That seems like a major bottleneck that could fracture the One Ring ambition.
This raises an absolutely vital question about how entrenched geopolitics can and often do override even the most cutting-edge technology. It's a reality check. While JPYC envisions numerous bridges, a direct or even indirect link to Russia's digital ruble remains highly improbable due to the harsh geopolitical realities. Japan, aligned firmly with G7 nations, has imposed strong, comprehensive sanctions on Russia following its actions in Ukraine. A direct, automated JPYC digital ruble bridge would be a clear, unambiguous violation of these international sanctions. It would risk Japan's standing and its entire financial system's integrity. Just not feasible. Even China, despite a strategic partnership with Russia, is extremely careful to avoid direct, large-scale sanctions violations that could jeopardize its own access to the global financial system, particularly given the threat of secondary sanctions from the US and EU. There isn't an automated eCNY to digital ruble link in place, even in pilot form, and major Chinese banks actively reduce transactions with Russian counterparts out of fear of those very secondary sanctions. They're treading carefully. The BRICS group, while a forum for cooperation between Brazil, Russia, India, China, and South Africa, is not a tightly integrated financial bloc that can simply override these global financial constraints or provide a safe haven for such integration without significant risk. Their financial systems largely remain separate.
So even if Russia had its own private ruble stablecoins like A7, A5, or RUBX, these couldn't simply be integrated into a G7 aligned system like JPYC. No backdoor.
No, absolutely not. These private ruble-pegged stablecoins are often used specifically for sanctions evasion and operate in a deep legal gray area. They lack any semblance of G7-style regulatory trust or transparency. From the perspective of countries like Japan, they are politically toxic. They fall squarely into that gray zone category we discussed with Tether, but with even greater geopolitical and legal baggage, much riskier. A more realistic alternative for payments between, say, India and Russia would likely occur through a direct bilateral bridge between India's digital rupee and Russia's digital ruble, operating entirely outside of G7-aligned financial systems. These are essentially parallel tracks, highlighting that even the most innovative digital payment rails cannot override fundamental geopolitical realities and sanctions regimes. Technology has limits.
That's a crucial dose of reality in an otherwise optimistic vision. And it brings up another vital consideration when we're talking about global digital hubs, especially with Hong Kong acting as a super connector, data sovereignty, and the risk of surveillance. Could a Hong Kong-based hub open up pathways for mass surveillance and data gathering by the Chinese government? And what about JPYC's promise in this regard? This feels like a fundamental trust divide.
You've hit on arguably the most critical geopolitical consideration for the future of digital finance. Yes, a Hong Kong-based hub, while efficient and boasting robust financial regulation on paper, does carry a significant and inherent risk of mass surveillance and data gathering by the Chinese government. Despite Hong Kong's one country, two systems principle, it operates under Beijing's national security law, which grants mainland authorities extremely broad powers to demand data from businesses operating within the territory. Mandatory identity verification for Hong Kong stablecoin holders, for example, creates a centralized database that could potentially be accessible to Chinese authorities. For companies from democratic nations, this creates a fundamental trust deficit regarding data privacy and transactional integrity. It's a real concern. Now compare that to JPYC. As a G7-based stablecoin operating under strict Japanese law, JPYC offers incredibly strong data privacy protections, thanks to Japan's Act on the Protection of Personal Information, or APPI, and its recognition for EU adequacy, which means the EU considers Japan's data protection standards equivalent to its own tough GDPR. The Financial Services Agency, the FSA, is not subject to foreign national security laws demanding mass data collection. Critically, JPYC can create separate, tailored, and very specific agreements with partners like JP Morgan. These agreements can be meticulously structured to ensure that only JP Morgan has access to its clients' transaction data, and JPYC, acting essentially as digital plumbing, only sees the JPYC transactions necessary for conversion and settlement. This mechanism rigorously preserves client confidentiality. It compartmentalizes the data.
Okay, so for companies and even governments prioritizing data sovereignty, the control over their digital information, the JPYC hub model offers a secure, privacy-focused digital payment bridge. This effectively positions it as a key player in a network of trusted corridors rather than a single, potentially surveillance-prone global hub. That's a powerful and unique differentiator, isn't it?
Precisely. In a world increasingly concerned with who sees your data and what they do with it, this makes data sovereignty a core competitive advantage for JPYC in the global digital finance landscape. It allows entities to participate in a hyper-efficient system without compromising their fundamental privacy principles. Huge selling point.
Let's turn to the roadmap for JPYC to achieve this kind of dominance, this one-ring status. Many might naturally assume the biggest challenge is the technology itself, building robust blockchain infrastructure, automated bridges, managing liquidity across global markets. But you suggested that the myth of technical difficulty might actually be just that.
Yeah.
A myth that's counterintuitive.
It is surprising for many, yes, but it's crucial to understand. The technical scaling for JPYC designing robust blockchain infrastructure, building those complex automated bridges, and managing liquidity pools across various digital assets is, believe it or not, largely the easier part. This type of infrastructure is inherently scalable, and it's primarily a software and integration challenge. It's complex, yes, but it's a known problem with established solutions, readily available skilled engineering teams, and existing protocols. The tools are there.
So if the technology itself isn't the biggest hurdle, what is the real bottleneck for this global vision? Where's the friction?
The real persistent bottleneck for global stablecoin adoption and interoperability is almost always navigating global regulatory landscapes. Different laws across different countries for anti-money laundering, AML, and know your customer, KYC requirements, licensing, foreign exchange rules, data privacy laws. That is the true multifaceted challenge. It's a patchwork quilt of rules. However, and this is JPYC's unique advantage, because Japan already has a clear, active, and fully implemented legal framework, along with strong government support, JPYC's domestic regulatory challenges are largely managed and understood. For cross-border expansion, these issues, while still complex, can be navigated through strategic cooperation with partners and by leveraging the yen's perceived geopolitical neutrality. This combination of proactive regulation and diplomatic advantage gives JPYC a significant first-mover advantage, effectively sidestepping the biggest hurdle others face. They're starting from a much better place.
Okay, another tricky area often overlooked is mastering real-time exchange rates across multiple currencies for seamless conversion. That sounds like an accountant's nightmare in the traditional system. How can JPYC solve this efficiently and with trust?
You're right, it is tricky, but it's entirely solvable with existing technology and a very pragmatic approach. There are several solution strategies, often combined. You could have centralized pricing feeds, where a trusted operator like JPYC itself or a partner bank provides official real-time rates, simple, auditable, and clear. Reliable. Then there are decentralized oracles like Chainlink, which pull real-time FX rates from multiple reliable exchanges, making the process transparent and tamper-resistant by design. More Web3 native. We also have automated market makers, or AMMs, and liquidity pools like those seen on platforms such as Uniswap, where rates are determined algorithmically based on supply and demand. This offers automated, decentralized exchange, but it requires deep liquidity to prevent price slippage, which can be a challenge. For JPYC, the most practical and secure approach would likely be a hybrid approach, combining the best elements. Central reference rates for stability, on-chain oracles for transparency, and potentially liquidity pools for rapid, automated exchange, all working together.
That still sounds like a lot of moving parts to coordinate globally. Could JPYC simplify this by taking a more pragmatic approach, say handling each exchange rate scenario on a case-by-case basis, making a specific agreement with the Chinese bank for ECNY or with Circle for USDC on which exchange rate to trust? Kind of like the spoke deals.
Yes, exactly. This is where that pragmatic approach truly shines and is likely the fastest path to adoption. JPYC can establish specific bilateral agreements with each partner, whether it's a regulated Chinese bank for ECNY, Circle for USDC, or eventually the European Central Bank for a future EUR. These agreements would precisely define which reference rate to use, the timing and frequency of rate updates, and any associated fees or spreads. All agreed upfront. The advantages of this method for you, the user or business, are clear. It brings simplicity, predictability, and transparency for all parties involved. Regulators, for instance, would see that these rates are pre-negotiated, clearly defined, and auditable for each specific trusted channel. This removes the enormous burden on JPYC to develop a single, complex, universal FX calculation system from day one. Instead, it allows JPYC to start with high-volume, high-trust corridors, expand gradually, and build greater automation on top of these trusted negotiated channels. This makes real-time FX management far more manageable and accelerates the one-ring vision by building trust incrementally, step by step.
That brings us to the exciting part. How quickly can JPYC go from being a pioneering startup to running this one stablecoin to rule them all global operation? That initial roadmap suggested 5+ years for this level of dominance. Can that be accelerated tremendously? Can they hit fast forward?
Absolutely, it can. While a 5+ year roadmap for such monumental global dominance is realistic for organic growth, JPYC has the potential to tremendously speed this up, potentially achieving many of its core goals in just 2 to 3 years, especially with substantial funding and a truly smart, aggressive strategy. This is where what we might call the mega growth plan comes into play. First, strategic partnerships are absolutely key. Collaborating deeply with global banks like JP Morgan or HSBC, major payment providers, and even existing highly regulated stablecoin issuers like Circle can immediately leverage their compliance infrastructure, their massive liquidity pools, and their existing customer bases. This is about leveraging others' established networks, not reinventing the wheel everywhere. Second, regulatory acceleration. JPYC can work incredibly closely with the Japanese government to actively expand international regulatory support and negotiate pilot programs directly with foreign regulators in China, the EU, India, or other key markets. This isn't just waiting for rules, it's proactive engagement to shape the environment. Third, technical shortcuts. Instead of building every single piece of infrastructure from scratch, JPYC can judiciously utilize existing secure stablecoin protocols and cross-chain bridges and rapidly employ advanced blockchain scaling solutions that are already proven. Smart integration. Fourth, focus corridor adoption. A smart play is to prioritize high-volume Asia-Pacific trade first, for instance, establishing that JPYC to ECNY bridge, then rapidly expanding to USD stablecoins for broader global reach. This creates powerful early network effects and demonstrates value quickly.
And if huge amounts of funding flow in, you mentioned they could do all of this in parallel, effectively compressing the timeline. That sounds intense.
Exactly. With significant capital injections, JPYC could move from sequential development to parallel processing across multiple fronts. It's like running multiple races at once. Imagine a dedicated technical track developing multiple currency bridges and advanced FX automation simultaneously. A parallel regulatory track engaging with multiple foreign regulators in China, the EU, the US, India, all at the same time. And an adoption track onboarding numerous multinational corporations and banks concurrently, demonstrating clear use cases and building momentum. This parallel processing, fueled by strategic funding and exceptional coordination, is the ultimate accelerator. It compresses years into months, making funding and strategic partnerships the critical drivers, not just technical prowess. This shifts the goal from organic growth to hypergrowth. It's ambitious, but possible.
Wow. This sounds like it could truly reshape the global financial landscape. If JPYC successfully becomes de facto global stablecoin hub, what are the competitive implications for existing USD-pegged stablecoins like USDC or even JPM coin? Are they playing catch-up, or does the landscape just get more diverse and complex?
This is where your provocative question truly lands, and the answer is nuanced but impactful. If JPYC achieves this one-ring hub status, it would have significant competitive implications for existing USD-pegged stablecoins, which currently dominate the space. First, there would be competitive pressure and potentially fragmented liquidity. JPYC could carve out significant market share, especially in critical Asia-Pacific markets, making USD stablecoins less universally dominant for certain types of cross-border transactions. Competition heats up. Second, U.S. regulatory headwinds from the Genius Act could pose challenges for smaller U.S.-based stablecoin issuers with increased compliance burdens and operational costs during that transition period we talked about. Meanwhile, JPYC, with its clear, active, and fully established Japanese regulation, could attract international businesses seeking immediate regulatory stability and clarity, giving them a distinct advantage during that window. Third, we could see a fundamental shift towards reserve diversification. Large institutions, and even potentially some central banks, might start holding yen stablecoins alongside USD stablecoins. This could foster a more dual standard or even multi-currency global digital system rather than a purely USD-dominated one. A more balanced portfolio, if you will. From an EU perspective, JPYC offers limited direct advantages for intra-EU payments because they already have incredibly efficient systems like SEPA, the Single Euro Payments Area, and are actively pursuing their own digital euro initiatives they're covered internally. However, JPYC could truly shine for cross-border payments involving Japan or Asia, bypassing slower USD or traditional euro rails. For example, Siemens, legally operating a JPYC account in Japan, could make payments to China through JPYC, potentially avoiding direct EU regulations if the transaction is not specifically targeting EU entities or customers. It offers strategic flexibility. So in summary, a de facto yen stablecoin could carve out a strong, credible global niche, particularly in Asia-Pacific and emerging markets. USD stablecoins would not disappear, not at all, but they could face reduced dominance, fragmented liquidity, and potentially higher compliance costs as they navigate their own evolving regulatory landscape. It's not a winner-take-all scenario, but a significant rebalancing of power.
What a journey. We've discussed the groundbreaking regulatory clarity coming out of Japan, the incredible potential of JPYC to become a global payment hub with automated bridges, linking regulated digital currencies like China's ECNY, India's digital rupee, trusted USD stablecoins like JPM Coin and USDC, and potentially even a future EEUR. It's quite a network. The idea that one neutral, trusted yen stablecoin could simplify all international transactions, making them faster, cheaper, and more secure, is a truly remarkable possibility. It's a vision of a truly interconnected, hyper-efficient global financial system emerging before our eyes. Really something to watch.
It absolutely is. And it's a vision that transforms not just the technology behind money, but the very concept of trust and cross-border finance. Imagine a world not too far off where your international payments flow instantly and seamlessly, anchored by a neutral yen stablecoin, chosen for its trust and efficiency rather than geopolitical might. What does this mean for the future of currency competition, for global trade, for the privacy of your transactions, and ultimately for your role in this rapidly evolving digital economy? The very concept of money and how we interact with it globally is being fundamentally redefined as we speak. A lot for you to think about.